So friends, welcome, namaskar. Let us start with the new topic, that is public finance. In this public finance, this is the lesson number 1. And before I move ahead, let us show you a little bit exam relevance of the public finance and what are the important components of the public finance. So this public finance, this has many components. First is the fiscal policy. Then we will discuss about the budget. So in the budget we will discuss capital expenditure, revenue expenditure, capital receipt, revenue receipt. We will discuss about the deficits, budget deficit, current account deficit, revenue deficit, etc. And finally we will go to the taxation. In the taxation we will discuss all kinds of taxation, the different fiscal concepts. Then we have this finance commission, etc. If we see from the examination perspective, in the prelims examination, this chapter can give up to between 2 to 5 questions. This chapter is one of the very important chapter apart from the banking external sector. Therefore, I request you, please understand this chapter carefully and you can really increase your score. So in this session I will discuss about the basics of the public finance, the meaning, scope, what are the functions of the public finance. Then we will discuss about the difference between the public finance and the private finance. We will see the meaning of the fiscal policy, different types of fiscal policy, the tools of the fiscal policy, and then we will see the counter and the pro-cyclical fiscal policy. And finally, we will compare the monetary policy with the fiscal policy. So first of all, what is the meaning of the word public finance? Right? So public here basically means the government. We are talking about the government. We are not talking about the public. So here the word public will mean public finance. So whenever you hear the word public expenditure, public income, public revenue, just understand that this is basically the government. Then we will discuss the word finance. What is the meaning of the word finance? The word finance basically represents the different money matters. So the government collects the revenue from the people in the form of taxes, in the form of user charges and other ways. Secondly, the expenditure. The government expends on different activities, food, health, education, infrastructure. It gives subsidies. Then the government sometimes takes the loan, which is also called as the debt. So whenever the expenditure is more than the revenue, so there is a shortage. This shortage is met with the help of the loan. And finally, we have the financial administration. This financial administration involves all kind of budget related activities. So preparation of the budget, estimates, and laying down the budget in the public domain. So all these, they form the scope of the public finance. They form the scope of the public finance. So public finance, what are the functions of the public finance? What are the functions of the public finance? The first function is allocation. So the government decides what can be the sources of collecting the money. Will it be through the taxes or will it be through the borrowing? How much taxes, how much borrowings, right? So this is one thing, that we are deciding how much. Then why we should levy the tax? On which area we should levy the tax? Whether the tax should be levied on the goods or services or income. It ensures that any particular citizen, any particular category of business do not feel extra burden of tax. Right? So not only the quantity but also the quality of these functions is very, very important. Not only the quantity of how much tax we are going to collect, but also the quality of the decision, that whether the tax which we are collecting is appropriate or not, that has to be seen. In the allocation, we first see how much we can get through different sources, then we allocate that function, we allocate that those finances to the different areas. How much is required for the public welfare in the form of food, education, health, housing? How much is required for the businessman for basic infrastructure like road, power plant? How much is required for the social security in the form of pension? So all these areas are looked into detail, and it is decided that how much is required, and secondly, why any area requires any amount. So for example, in India we have a huge young population, so we need to invest on the education and skill development. Our elderly population is increasing, we need to invest on the health. We need to promote the MSME sector because that is the provider of the export, employment and many other areas. So not only the quantity of expenditure but also the quality of expenditure that has to be seen. So this allocation function takes care of that, how the money is going to be distributed into different areas. The second function is distribution. And in fact, this should be called redistribution. So friends, in India we have scarce resources and there are huge competing needs. And more importantly, whatever resources we have, those resources are allocated in a very unequal way. They are available in a very unequal way. Only 1% people have more than 20% of the national income and wealth, and the bottom 70% people have around 20% of the national income and wealth. So top 1% people are having the income and wealth equal to bottom 70%. This huge inequality is the genesis of many diseases, strain on country in the form of increasing population. It is genesis of many public tensions, civil tensions, crimes, unemployment, all that. So through the public finance, redistribution is done. How the redistribution is done? The taxes are levied on the rich people and the subsidy is given to the poor people. So you can see during the coronavirus crisis, during this lockdown, the government is taking care of the poor people. The government is providing food, shelter, health facilities to them, right? So this is basically nothing but the redistribution function. And third is stabilization. What is the meaning of stabilization? So friends, our economy passes through different phases. Sometimes the growth rate is very, very high, sometimes the growth rate is low. Then there are various global and the national crises. So for example, the crisis happened in 1991, in 2008, and now we are facing the crisis of the coronavirus. The global economy is going down, stock markets are crashing, public is in shock. So at this time, it is the public finance, the government money, which takes care of the stabilization. So stabilization basically means maintaining the stability. During the crisis time, the government ensures that people are not unemployed. Whosoever people are, they are getting the food. The businesses are getting the sufficient money. There is sufficient availability of the basic services, etc. So this boom and bust, it is part and parcel of the life. And through the public finance, the government ensures that even during the booms and bust scenario, there is certain level of stability in the country, right? So this stabilization function is performed through increasing the expenditure and reducing the taxes and many other activities. So these are the functions of the public finance. So let us see. Public finance, that is finances of the government, includes all those matters which are connected with public money, that is the money government gets, spends, borrows, lends, raises or prints. In India, if we talk about the central government, we have the Ministry of Finance, and she is our goddess Lakshmi, Shrimati Nirmala Sitharaman. So we can see she is providing money for the housing, education, for the businesses, for the savings, etc. It does not only discuss the issue of how much of the country's resources the government should acquire for its own use, but also discusses the efficiency with which the money should be used. Here you can see public finance is the study of finance related to the government entities. It revolves around the role of government income and expenditure in the economy. Scope, public income, income of the government, it can be through the tax income or non-tax income. Non-tax income, for example, disinvestment income, interest income, user charges. It can be in the form of public expenditure, money spent by the government entities on the health, education, infrastructure, housing, public debt. So whenever the public expenditure exceeds the public income, and in developing countries it is a very usual scenario. Financial administration, all the budget and the other government policies. Functions which include allocation function, it studies how to allocate a public expenditure most efficiently to reap maximum benefit with the available public wealth. So our resources are scarce and there are competing needs. So we need to ensure that from the available resources maximum benefit is reached. Distribution function, it aims at reducing the inequalities through the redistribution of income and the wealth. And stabilization, it aims at eliminating the business fluctuations and its impact on the economy. So in the distribution we are talking about the inequalities, and in the stabilization we are talking about the fluctuation of the economy in different times. Now comes, what is the difference between the public finance and the private finance? So private finance means the finance of you and me, finance of our family, which is limited to our own life. So if we see the difference between the public finance and the private finance, there are some points of difference. Public finance and private finance. First of all, the public finance, the purpose of public finance is to take care of the collective wants of the society and the nation. The purpose of private finance is to take care of the personal benefit or personal wants. So in the personal finance, we are talking about the family's income. How much is the family income? How should we spend the family income? Should we buy the new house? Should we spend on the higher education? And all those activities. So that is a private finance. In the public finance, we are talking about whether we should give high amount to the health sector, to the education sector, or we should give amount to the infrastructure sector. We are talking about the subsidies. We are talking about containing the inflation. We are talking about providing the jobs, right? So in case of public finance, the decisions are taken at the macro level, and the private finance is actually talking about the micro level, individual and family level only. In the public finance, since it is all about the public, therefore this public finance is transparent. We all know how much is the expenditure of the government, how much is the income of the government. But in case of private finance, all this is secret. We do not know what is the exact income and expenditure of a particular family, of a particular person. In case of public finance, first we decide the expenditure, that how much is the expenditure. So the government will decide how much is the estimated expenditure for the health, education, for the subsidies, for the infrastructure, etc. And accordingly, we will raise the income, we will levy the taxes, we will sell our existing asset. So first income and then expenditure. First expenditure and then income. However, in case of private finance, first we see how much income we earn, and depending upon that, we see that how we should expend that money. So depending upon our income, if our income is 1 lakh rupees per month, then we will go for a particular set of commodities. If our income is 1 crore per month, then we can go for the Audi, Mercedes, for big bungalow, etc. So our expenditure depend upon on our income. And in the public finance, first the government assesses the expenditure and then it generates the resources, right? In case of public finance, the important tools include the taxes. In case of private finance, the important tool include the personal earnings. From job, business, or any other work which is being done by the particular family or family head. There are many more points we will see. So, public versus private, let us see. So, here you can see in this image, here in the private finance, the person is taking care of own. And here it is for the people. He is the king, and they are the ministers of the king or guards of the king, and they are thinking about how should we expand, how should we generate the resources so that we can maximize the benefit of the people. Now you see, public finance it is at the macro level, private finance it is at the micro level. Public finance, it wants to satisfy the collective wants. Private finance, it wants to satisfy personal wants. Public finance, here first we see the expenditure and after that we see the income. So the public income is generally adjusted or based upon the public expenditure. In case of private finance, an individual adjusts his expenditure on the basis of his income. Public finance is more elastic. So public finance is more elastic because the government has many more avenue sources for the income. But in case of individual, it is comparatively rigid because the individual do not have so many avenues and resources like the government. Public finance also takes into consideration the future aspect. So public finance always takes care of the future generation, education of the people, the infrastructure for the long term. But in case of private finance, although future is a factor, but it is more guided by the present benefits, the present luxuries. The public finance, there is mostly the deficit budget. So especially in the countries like India, mostly there is expenditure more than income. That is deficit budget. The purpose of the public finance is not to earn the profit. The purpose is to ensure the maximum welfare of the people, and there is a maximum possibility of the deficit. However, in case of private finance, normally there is a surplus budget. That means whatever income the person is earning, the expenditure is less than that, and person is basically trying to save the money from the existing income. So in case of public finance, there is deficit. In case of private finance, there is surplus or savings. Public finance is a matter of public, so it cannot be kept sacred. And the private finance, it is the individual financial transaction, therefore it is kept sacred. So friends, now let us understand the meaning of the word fiscal policy. The word fiscal means state treasury, and the policy means the rules regarding the decisions which are taken with respect to the state treasury. Let us understand this term in much more detail. So fiscal policy means the policy regarding the state treasury. So this policy takes the decisions regarding the government spending, and the government revenue. So how much is the government spending, right? And it takes care of not only the quantity but the quality also, whether the expenditure is wasteful in the form of fuel subsidy, whether the fuel subsidy is excessive, which is actually harmful to the environment, or it is productive in the form of skill development, education, infrastructure, etc. It takes care of the government revenue. It decides whether the revenue is coming through the taxes or it is coming through the loan. If it is coming through the taxes, whether the taxes are being levied in a particular way or they are haphazard, ad hoc, whether they are reasonable or not. Similarly, loan, whether the loan is not having the adverse impact, how much loan is being taken from the foreign nations, how much loan is being raised from the local sources, how much is the rate of interest. All these things are decided in the government revenue regarding decisions. So all these decisions are taken having certain objectives in mind. The objectives are, first of all, generation of maximum national income. National income means GDP. How to increase the production of the goods and services in the India. So the spending as well as revenue both are considering the national income portion, right? How to reduce the inequality. How to mobilize the resources through the savings. So the government gives the tax exemption for the savings so that people can deposit the money in the banking sector, in the capital market, and that money can be channelized to the industries. For the balance of payment, how to increase the export, right? So the government gives the tax exemption. Government builds the tax infrastructure. So spending is done on the export infrastructure and the tax reduction is given on the export transactions. So government wants to promote the export so that balance of payment can be taken care of. Inflation is also taken care of. So government increases the supply of those commodities which are having the high prices in the market so that the overall prices can come down. The government also reduces the taxes so that inflation can come down, right? So in this way we can see that all these objectives are met with the help of the government spending and revenue decisions. The government spending and the revenue decisions. So this is all about the fiscal policy, the basics of the fiscal policy. Now let us see. So here you can see in this image, she is the Finance Minister of India, Shrimati Nirmala Sitharaman, and she is taking care of the bad economy. Our economy is in the hospital. Coronavirus lag gaya hai isko. So our economy is in bad shape, and she comes and she gives the bouquet to the economy in the form of spending, in the form of reduction in the taxes, right? And all that is done with the help of budget. So budget is basically part of the fiscal policy. Fiscal policy is exercised with the help of the tool called budget. The word fisc means state treasury और सरकारी खजाना, हिंदी में अगर बात करें तो, and fiscal policy refers to policy concerning the use of state treasury or government finances to achieve the macroeconomic goals. Fiscal policy involves the decisions that a government makes regarding the collection of tax revenue through taxation or about spending that revenue. It is a sister strategy of monetary policy, right? So we will also see the difference between the monetary policy and the fiscal policy at the end of this session also. So here you can see the meaning and definition. The overall activities of the government through the budget comes under the area known as the fiscal policy, right? So we will discuss more about the budget in the coming session. A policy under which the government uses its expenditure and revenue program to produce desirable effects. So desirable effects means the developmental objective, national income, reducing inequality, promoting the export, controlling the inflation, and avoiding undesirable effects on the national income, production and employment. It deals not only with the quantity but also with the quality, right? So not only how much taxes should be raised but also from what sources. Why we should ensure that the taxes are not unreasonable on a particular section of goods, on a particular section of people. The quality of public finance. It can achieve important public policy goals like growth, equity, small scale industries, rural areas, labor intensive growth, export promotion, development of sound social and physical infrastructure. Now what are the objectives of the fiscal policy? So we want to become the $5 trillion economy. to achieve the goal of $5 trillion economy, we have to fight with the menaces like unemployment, farm distress, bank MPA, demonetization, inflation. Indian economy, this is the Indian economy, right? So here we can see objectives of the fiscal policy. First is development, right? Improving the quality of life of the people by effective mobilization of resources through savings, lending, and all these activities are done by what? By the banking activities. Reduction in inequalities of income and wealth. So as I already told you, one of the function is redistribution function, price stability and control of inflation, employment generation. When there is increase in national income, that means there is more production, the jobs will automatically be created. Reducing the deficit in the balance of payment. How? By increasing the export, by promoting the export infrastructure, reducing the taxes on the export, and by reducing the import. How we can reduce the import? By levying the duties on the import, or by manufacturing those goods inside the country only. Increasing national income, that is GDP improvement, and development of the infrastructure. The government spends on the infrastructure in a big way, and that is possible only through the fiscal policy. Now, what are the tools of the fiscal policy? So there are primarily two tools. One is the public revenue, another is the public expenditure, right? And we will discuss all this in the next session when we discuss about the budget. But here, can I say, the primary source of income is taxation, right? So can we say there are two primary tools? One is the taxation, another is the expenditure. So two primary tools of the government finances, the taxation and the expenditure. These are the two primary tools. Taxation, through it the government collects money from the public. So you can see this, the common man is being under the burden of the tax. The common man is crying like anything. Government spending ensures economic growth. The government needs to spend money on the projects that matter. So here you can see our finance minister is distributing the food to the poor people, and they are becoming really happy. Now there are three types of fiscal policy. One is neutral fiscal policy. That means when the spending is equal to taxes, and this is basically reflecting the state of equilibrium. This is an ideal situation. This is practically not possible. Another is expansionary fiscal policy. That means the government is spending huge amount of money. Normally this kind of policy is adopted in case of recession, in case of crisis. For example, right now we are facing the coronavirus lockdown crisis. So normally during these times, this kind of expansionary fiscal policy is adopted. Contractionary fiscal policy, this kind of policy is adopted when there is huge boom. So in the boom time, the government wants to contract the economy. The contractionary fiscal policy is adopted where the spending is reduced from the side of government, right? The purpose is not to control the economy. The purpose is not basically to avoid the adverse impacts of the high speed of growth, to control the adverse impact on the environment, to control the adverse impact in the form of rising inequalities, right? So we can have neutral fiscal policy, expansionary fiscal policy, and contractionary fiscal policy. Now there are primarily two kinds of fiscal policy if we see in different times. One is automatic fiscal policy, which is followed in the normal times. So in the normal times, the government follows this policy. Government takes care of the requirement of different sectors of society, and accordingly it formulates the decisions regarding the taxation and the spending. Discretionary foreign fiscal policy is basically adopted in the difficult times, or rather we can say in the abnormal situation. So when the situation is of crisis, there is recession, right? Or there is excessive boom, and because of boom there is high inflation, right? So whenever there is inflation, there is recession, we call it anti-recessionary fiscal policy, or this is also called as counter-cyclical fiscal policy during the recession, right? This discretionary fiscal policy, this is adopted in the abnormal time, and another name given to this policy is also counter-cyclical fiscal policy, right? Counter-cyclical fiscal policy or discretionary fiscal policy. In the counter-cyclical or discretionary fund policy, it is adopted either in kind of recession or in times of boom, right? In the time of recession, this is called counter-cyclical fiscal policy during the recession, and during the inflation, during the inflation and boom, this is called counter-cyclical fiscal policy during the boom. So you can see counter-cyclical fiscal policy. So this is adopted either in time of boom or in time of recession. And here the purpose is to stabilize the economy. When there is boom, that means there is a high inflation also. So at that time the government takes certain steps so that the inflation is controlled. And whenever there is recession, there is loss of job, there is a reduction in the national income, and most of the people are in difficulty. So at that time also the government takes certain steps. So all these are basically to basically achieve the objective of stabilization of the economy, right? So we already discussed one of the function of the public finance is to stabilize the economy. Counter-cyclical fiscal policy works in two different directions. We will see the two different directions, right? So either it can be anti-recession or it can be anti-boom, right? Pro-cyclical fiscal policy is basically opposite of the counter-cyclical. So counter-cyclical fiscal policy works against the trend. If we are in recession, we will follow the expansionary fiscal policy. If we are in boom, we will counter the boom, right? So this pro-cyclical fiscal policy is basically completely opposite to the counter-cyclical fiscal policy. In the pro-cyclical fiscal policy, this is primarily used during the boom, right? So we want to accelerate the speed of the boom. We want to accelerate the benefits of the boom to the large number of people. So this pro-cyclical fiscal policy is primarily used in case of boom. Such a situation increases government debt and creates inflationary pressure, especially in the developing countries. Now let us start with the first one, that is counter-cyclical fiscal policy during the recession. So first of all, what is the scenario during the recession? We have already discussed the recession in the chapter of economic growth and development. So normally during the recession, there is a reduction in the production. Because of reduction in the production, there is reduction in the income of the people. People are jobless, and the aggregate demand in the market reduces, right? So the consumption requirement, aggregate demand of the goods and services comes down. The prices of the goods and services comes down. Unemployment increases. Poverty increases. So here in this cartoon you can see berojgari, that is unemployment, mehangai, that is inflation, garibi, that is poverty. So in the recent times, some steps government has taken, and some people believe that this recession which we are facing, not recession but slowdown, right? The slowdown that we are facing is because of the activities like demonetization, GST, right? Our economy is bad, and then there are many non-economical factors because of which the economy is coming down. In the recent time, this corona issue, right? So during the recession time, what government does, counter-cyclical fiscal policy during the recession. So during the recession, the government will follow expansionary fiscal policy. What is the meaning of expansionary policy? Fiscal policy? That means it will increase the government expenditure. It will expand on the public welfare. It will provide the basic services to the people like food, health, education. It will expand on the infrastructure so that the productive capacity of the economy is increased, so that businesses can build, and it reduces the taxes. For example, in the recent time, we can see the corporate taxes were reduced. The rate of taxes in the corporate sector was reduced so that they have the less burden on the taxation, and more investment can come from the foreign countries. Because of increased expenditure and reduced taxes, there is deficit. There is deficit. So to finance this deficit, the government has two different resources primarily. Either it can take the loan. The loan can be taken from the market, or it can be taken from the foreign country. It can be raised through different instruments like a small saving instrument. Or another source can be printing the money. The printing the money can be inflationary, and it is like avoided to the extent possible. Right? So this is how the fiscal policy works in case of the recession. So in case of recession, the primary objective is basically to follow the expansionary fiscal policy, so that when government expenditure increases, so the government expenditure will be put into the market. The people can buy the goods. The demand will increase. When the demand increases, it will stimulate the production. The businesses will build. They will provide the jobs. The inflation will come down, and by reducing the taxes again, the businesses will build, the supply of the goods will increase, etc. So, counter-cyclical fiscal policy during the recession. Recession is a business cycle situation where there is slowing demand and falling growth. So this is the prime indicator. The demand is slowing and growth is also slowing. GDP growth, production. The production of goods and services is coming down. Here the government's responsibility is to generate demand by fine-tuning taxation and expenditure. So what is the primary purpose of the policy? To generate the demand. We want to generate the demand. How we can generate the demand? By giving money in the hands of the people. How the money can be given? Through subsidies, through direct benefit transfer, through spending on the health, education, food, housing, infrastructure. By building the infrastructure, the people will get employment in the infrastructure building activities. They will get the job. Through the job, they can have the money in their hand. And when they have the money in their hand, they can generate the demand. They will demand the goods and services, right? So the primary responsibility of the government is to generate the demand. And this is done through reducing the taxes so that the people have more disposable income and increasing the expenditure. So discretionary policy, fiscal policy, anti-recessionary fiscal policy. So aggregate demand is decreasing and private investment is falling. Anti-recessionary fiscal policy, increasing the government expenditure and reducing the taxes. We have already discussed all these things, right? I am just showing you in the slides. So increasing the government expenditure, you can see the finance minister is going to the economy and saying that please take the food, and economy is saying that please feed me, then I will stand up. Increase in the government expenditure. How the government expenditure is increased? In the infrastructure, in the form of roads, dams, ports, telecom activities. Government buys various type of goods and materials, right? So it buys the goods and materials for the health, for the education, and distributes it to the common public. It employs the labor through various activities. What is going to be the effect of such kind of policy? So basically, through such kind of policy, the GDP growth rate increases, right? Demand increases. GDP growth rate increase basically means the production increases. That means the jobs increases. So you can see our finance minister is basically has taken on this arrow of the economic growth increase. What is going to be the effect? Direct effect is increase in the income of the suppliers and the sellers, increase in the demand for the capital goods. When government has decided that road project should be built, that means the capital goods will be sold more. Indirect effect, consumption increases. When people have more income in their hand, they can expend more. Increase in the demand for the consumer goods. Expansion in output. Automatically, when there is more demand, more and more production can happen. Generates employment. When there is more production, more and more people can be employed in the jobs. How large should be the increase in expenditure? That is not our point of discussion. Reduction in taxes, right? So we saw recently that there was a tax reduction for the corporates. The rates of taxes were reduced down for the corporates. So what is the impact of the reduction in taxes? Increase in the disposable income, increase in consumption. When tax comes down, people have more money in their hand, they can expand that money in the market. So it will increase the consumption. When consumption is increased, then it creates demand, more production happens, and it creates employment, national income and output. But it leads to budget deficit, which can be financed either by borrowing or by printing of more money, creation of more money. So which is better? Whether the government expenditure is better or the taxes are better? This is a question to discuss. So this is a very subjective aspect. If our government expenditure system is good, that means our public agencies, infrastructure building agencies, railway, power plant operational agencies, all those are efficient. If we can ensure that the money reaches to the public in an efficient way, in the productive way, then we should expend more and more money. And if we do not have appropriate expenditure system, that is we don't have efficient expenditure agencies, we can't ensure that the benefit is reaching to the people, then we should go for the reduction in taxes so that income is there in the hands of the people and they can expand as per their own requirement. In India, we follow a combination of both. Our efficiency in the expenditure is increasing. Now we have various tools of monitoring. We have IT tools of monitoring. We are using direct benefit transfer within the pockets of the beneficiaries, right? So nowadays we are becoming more and more efficient. On the other hand, the taxes are also being reduced so that the people have the money in their hand and they can expand as per their own requirement. So it depends on the role of public sector. If the public sector can overcome the failure of the free market system, however, public sector are efficient. If the public sector are inefficient and involves waste of scarce resources, then taxation is better option, right? So it all depends upon whether the efficiency is there in the expenditure system or in the tax collection system. How to finance, right? So when we are following the expansionary fiscal policy, that means our expenditure is increasing, taxation is decreasing. That means there will be a shortage of finances. From where to generate that finance? So that finance can be generated either from the borrowing or from the creation of new money. Both will have their own impacts. So if the borrowing is done, this is done from the public. If the borrowing is done from the public, then the businessman will have less money. So it will reduce the private investment because the government will compete with the businessman or the private investment, right? And it will also raise the rate of interest. The businessman will be discouraged to invest into the economy. Creation of new money. It will not reduce the private investment. It will have full expansionary rise in the government expenditure, but it will create inflation because when more and more money supply will be happening in the economy, then it will increase demand of the goods and services. That will be inflationary, right? So high inflation is not good. Another type of fiscal policy can be counter-cyclical fiscal policy during the boom. So if we talk about the boom, what are the characteristics of the boom? During the boom, the production is very high. Because of this, we have good number of jobs. Income of the people is increasing. Because the people have income in their hand, there is huge demand. And because of this demand, there is high inflation also. And this inflation can be having the adverse effect. So to control the inflationary conditions, what should be done? To control the inflationary condition, first, the government expenditure should be decreased. And second, the taxes should be increased. Right? The government expenditure should be ensured only in those areas which are productive. Wasteful government expenditure should be reduced. The taxes should be increased in such a way that people have less money in their hand so that they can expend less and inflation is controlled. As an ultimate result of reducing the expenditure and increasing the taxes, there will be some kind of surplus of money. This surplus of money can either be utilized in repayment or it can be utilized in keeping as reserve for future use. Right? Now let us see this particular aspect in detail. So the counter-cyclical fiscal policy during the boom time. Let us see. So you can see this is Indian economy. India is shining, high export, then everything is good. The elephant is moving with proud, and here the people are trying to control this elephant. So in case of boom, economic activities will be on the upswing. Amplifying the boom is disastrous as it may create inflation and debt crisis, and the government's responsibility here is to bring down the pace of economic activities. Increasing taxes and reducing public expenditure will make boom mild. Thus, slowing down demand should be the nature of counter-cyclical fiscal policy during a boom period. So this is the crux, slowing down the demand. So here you can see anti-inflationary fiscal policy. Aggregate demand is high in such case, and public investment is also high, and inflation is also high. This inflation can be disastrous. So in this case, we will reduce the expenditure or we will increase the taxes. Government reduces the expenditure. You can see here the finance minister doing the U-turn. Earlier it announced certain schemes and later on it is taking the U-turn. How does the government reduce expenditure? Reducing expenditure on the non-development or unproductive sectors like defense, subsidies, fuel subsidy especially, transfer payments like pension, etc. Decrease in income. So the salaries of the government employees might be reduced. Reducing the excess demand, right? Although this is a very rare situation, especially in the countries like developing country. Increasing the taxes, right? So increasing the tax burden on the common man. What's going to happen? Increase the tax. That means disposable income of the people is reduced, consumption is reduced, aggregate demands comes down, right? And it leads to the budget surplus. This surplus can be utilized either in repaying the public debt or in keeping the surplus for the future. So fiscal policy, if we see in the context of India, economic survey of 2017, it said that some pro-cyclicity is there during the boom period in India. India's fiscal stance has an inbuilt bias towards higher deficit, right? So mostly we are in the deficit because spending rises pro-cyclically during growth surge, right? So when there is growth surge, that is there is development, the growth is increasing. So the spending will also increase, while revenue and spending are deployed counter-cyclically during the slowdown, right? So during the slowdown there is counter-cyclical policy, and during the boom there is pro-cyclical policy. Policy trend since June 2019, India's economic growth slumped to an over 6-year low of 5%. In fact, after this corona crisis, I am afraid that this growth rate can come down to below 4% also. So there was low consumer demand and there was low private investment. That means we are in the recessionary situation. We are in the mid of slowdown. The government has recently announced a lot of measures, right? So government came down with the reduction in the corporate rates, then it came up with the infrastructure fund, one fund for the housing sector, real estate sector. During this corona crisis, the government came up with the Pradhan Mantri Garib Kalyan Yojana, and through this the government is actually increasing the expenditure and reducing the taxes, right? So we are basically following the counter cyclical policy during the recession right now. Now comes very important aspect, what is the difference between the fiscal policy and the monetary policy, right? So if we talk about the fiscal policy versus the monetary policy, let us see. So the fiscal policy, what are the important features as compared to the monetary policy? Let us see. So fiscal policy and monetary policy. So fiscal policy, it deals with the public finances, the government money, right? The monetary policy deals with the overall money supply in the economy, right? So it deals with the money supply in the economy overall. The tools of fiscal policy are the taxation and the expenditure. The tools of the monetary policy are primarily the interest rate in the form of repo rate. Fiscal policy, this is administered by the finance ministry or the government, and this is administered by the RBI, the central bank, and as of now the monetary policy committee after 2016. The goals of fiscal policy are multiple, primarily focusing on development, growth and welfare. And if we talk about monetary policy, the prime purpose is the price stability, right? Controlling the inflation. So these are the prime differences between the two policies. So let us see. Fiscal policy, change in the government spending and tax rate, right? It is done by the government. There is no specific target, but primary target remains in the form of development, equity, increasing the welfare of the people. Here, target is inflation. It is set by the central government and it is controlled through the interest rate and the money supply. It has the side effect in the form of government budget and the borrowing. Side effect is upon the exchange rate and maybe in the housing market or some other markets. It has huge political dimension because it is run by the government, and here the independence is more because RBI is an independent institution. However, in the same time, the independence of the RBI is under question. Still, we can't say much about that, right? So this is all about the fiscal policy and the monetary policy differentiation. With this, I complete this session, and in the next session we will discuss all about the budget. That session is going to be very interesting. Thank you very much. God bless you.